Well, I don't know if I have to introduce myself, but I am Bruno de Conti from the University of Campinas. And I'm really happy to be today here with a new role, in addition to this one of moderator, self-moderator, in order to present my research, because, well, following these seminars in the last months, I could realize how rich are the discussions that you make with all speakers. So I'm really looking forward for your questions, for your comments. I know it will be very interesting for me. Also because, well, this paper is published, as you know. You saw it at the New Political Economy, but it is an ongoing agenda of research. So all discussions will be very interesting for me. And obviously, I take benefit of doing this seminar this week and not, I don't know, in December, because then you already saw you assisted the presentation by Anina Kaltenbrunner, right? Which is a colleague who is developing very interesting research somehow in the same topic, but obviously I think I would have something new to say to you as well, but I take benefit of the introductory notes she made about the discussions on currency hierarchy. The presentation will be based not only in the paper I sent to you, which is this one, which was published last year in the New Political Economy, this last one. This one you're supposed to have read. But I also bring things here from my thesis, which I made here in France. It was a co-supervised thesis, so Campinas, Paris 13, back in 2011, and also from other researchers, but very importantly from an article I wrote with a colleague of mine from Campinas as well, Professor Ricardo Carneiro, who is one of the first persons in Campinas who started this tradition of studying what we name as currency hierarchy, at least in Campinas, right? Him with Beluso, for the Brazilians, you know him, maybe other Latin Americans know him as well, Beluso and Ricardo Carneiro. So I also bring things from this article, in case which was published, by the way, in the Cambridge Journal of Economics in a special issue organized by Anina Kaltenbrunner with other people. This is the outline. In addition to the introduction, I will talk about, well, the core of my presentation will be the introduction to the concept of international division of finance, and then we will discuss the structural differentiation and the structural trends related to the international division of finance, and then some final remarks. And then I start by, you all know it, but by reminding you that the discussions about the international division of labor are very old. Right? Actually, we had with Adam Smith, which is conceived as the father of modern economics, discussions about the division of labor. So the whole story about the pin, and then how productivity increases if some workers go into one specific task and other workers to other specific tasks, and so on and so forth. And then David Ricardo, as you know, brought this idea to the international arena, right? Making discussions about the international, what finally we could name as international division of labor. So it would be good for the economy, for the whole world, for the whole global population, to have some countries specialized in some specific goods, and then some other countries specialized in other goods. The whole discussion you also know, which is very old, as you can see, but which is still somehow shapes the way conventional or mainstream economics see the benefits of the international trade. Okay, in Brazil we still have a lot of economists who say that, well, we don't have to industrialize or to fight against de-industrialization. We have to specialize in what we are good, and we are good in mining and agriculture. Okay, and then it comes from David Ricardo, but it is still here. Okay, but obviously outside mainstream economics, we started having critical voices in regard to the international division of labor since Marx. Marx very clearly highlighted that, well, it was the industrialization in the European countries that finally shaped a world in which those industrial countries wanted to have agricultural goods and mineral goods from the periphery, and then to sell their industrialized goods, even to countries which used to have their own industry, like China or India, but then those industries were destroyed by the European industrialization and by colonialism or semi-colonialism, right? So Marx was already a critical voice on those alleged benefits of the international division of labor. But then in Latin America, we had very interesting discussions, and I'm aware that I think actually, I'd like to confirm, that you have some discussions in EPOG about ICLAC, right? You do? Okay. So it makes things easier for me as well. But it's a very rich moment in the history of economic thought, I think, for the whole globe, in mid-20s, sorry, when Raul Prebisch and then Celso Furtado and then other Latin American scholars all around the newborn ICLAC, right, the Economic Commission for Latin America and the Caribbean, United Nations, no, led by Raul Prebisch, started discussing what they named as underdevelopment. And then the whole discussion about underdevelopment was based in these criticisms to the International Division of Labor. At that time, there was this dichotomy, which is not true anymore, but well, a center which was a producer of industrial goods, and then the periphery producing mineral goods and agricultural goods, right? It changed, we will come back to that, but the essence is still the same. But still, what was very important and is very important is that they conceptualized the underdevelopment as something which is simultaneous. Underdevelopment, as you know, if you discuss it, CEPAL and ECLAC, you know it. Underdevelopment should not be considered as something which is only different from development in relation to the phase of maturity of the country. Putting it in easier words, an underdeveloped country is not a country which is on its way to develop, right? Underdevelopment coexists with development. More than that, they have a relation, a strong relation. Development and underdevelopment are two sides of a same dynamics, which is the constitution of the capitalist system and the modus operandi of the capitalist system. It depends on development and it depends on underdevelopment. And here Alexis Saloudian is a great expert. He is an expert precisely in those discussions about the Latin American structuralism. Okay, so this is the main idea. That's why they didn't use the term developing countries. I don't use, Alexis certainly doesn't use as well. It's not true, in our opinion, to say that, well, Brazil is a developing country. We are not developing. We are a big country, okay. We are one of the biggest peripheral countries, but we are still a peripheral country. We are not developing, right? Why? Because there are obstacles for this development coming from the legacies of colonialism, coming from the way our economy was shaped since its origin. Okay, so underdevelopment is not a stage for development. It's not a deviation of the development process. It's the way the capitalist system works with development in some countries, creating and recreating underdevelopment in other countries at the same time, simultaneously. Okay? Developed and underdeveloped countries are not in different phases in the historical process of development. They coexist. Okay? That's the main idea of ECLAC, and this is a crucial idea for what we will be discussing here today. Okay, the development of the center requires and promotes the underdevelopment of the periphery. It's functional to the development of the center. The underdevelopment in the periphery is functional to the development in the center countries. And then our claims in this paper, and many other scholars agree with that, is that the central elements of this structuralist view on the capitalist system and on the international economy are still valid. we obviously have to update it. The world has changed. 75 years of history have meant a lot of changes in the world economy. So we do have to make updates, but we still have International Division of Labor. We may name it as a new International Division of Labor, and there are discussions about this new International Division of Labor, but the essence of is still the same, right? We have the global value chains. So it's not true anymore that central countries are producing only manufactured goods and then peripheral countries are only producing agricultural and mineral goods. If you see the exports, the balance of payment or the trade account of Mexico, you will see, well, they are exporting industrial goods. Same for Vietnam and some other southeastern countries in Asia, and so on and so forth. So this dichotomy is not valid anymore, but still we have elements which are in line with what CEPAL-ECLAC was telling us 75 years ago, right? And then the whole discussion of the global value chains shows these asymmetries. The Smile curve, you've certainly had it in other discussions, and then the central countries which are producing, which are in we have the tasks in the production process which have the higher value added, and the peripheral countries with low value added, and so on and so forth, right? So we have to update it, but the crucial elements are still there. And we have a crucial difference also in this historical moment we are now living in regard to mid-20th century, which is financialization, right? So when they wrote their first papers, 49, no, it's the first manifesto, let's put it like that, of CEPAL, and they had just signed it 5 years ago, 5 years before, the Bretton Woods Agreement, right? So right after the Second World War, the whole idea was somehow controlling financial capital all over the world in order to avoid instability, in order to revamp the international trade. So you all know that, well, the period was characterized by much more controls in the financial account and, very importantly, controls on the exchange rates. So they had capital controls, all countries in the world. It was an important axe of the Bretton Woods system, and they had fixed exchange rate regimes with some variations, you know, 1% up or down, but still it was managed or administrated, managed exchange rate regime. Now everything is different, right, with financialization. And now I'll mention here what I understand as financialization. I'll come back to that later. So the whole motivation of the discussions we try to do in this paper and we try to do in this agenda of research, as Anina put it, and I would agree with her that it's a new agenda for research, come from the perception of this new context of capitalism with this finance-led capitalism, or the way you want to name it. And this geography of money, right? Geography of Money is a book by Benjamin Cohen. I don't know if you know him, from International Political Economy, which has been always important, but these discussions gained momentum nowadays. I've been studying it for the last 20 years now, but it's true that in the last 3 years, these discussions gained momentum. They are in the medias every day, right? Why? Very importantly, because of the weaponization of the US dollar, right? And then we can discuss it here as well. So the perceptions that we have to discuss the inequalities of the world also in the monetary dimension are even more clear now, because the US is using its currency as a weapon, right? It has always done that, but now, since it's doing against Russia, which is a big country, geopolitically important, and so on, then it's very, very clear. It's crystal clear, right? A currency can be used as a weapon. And then we have discussions in Argentina or in El Salvador related to the dollarization, non-dollarization. The usage in El Salvador, as you probably know, it's a dollarized country, but then they officialized Bitcoin as an official currency, right? The whole discussions about the BRICS currency, if it's going to happen or not. Brazil has now the chairmanship of the BRICS this year, as you know, and then we are starting the discussions, and there are divisions even within the national government. Some people willing to work for a BRICS currency, some people not willing, but still, and then there are consensus about the pertinence of fostering the national currencies for the intra-BRICS trade. So, well, in several countries, in several parts of the world, we do see very interesting and hot discussions about this that we are naming here as the International Division of Finance. Right. We are not alone on that. As I said, even in Campinas, Professor Ricardo Carneiro, Daniela Prates, Beluso, they have been discussing it for a while now. And then in other countries, in the UK, Nina showed you and talked about an article they wrote together which tries to define an umbrella concept, which is the international financial subordination, for those discussions as well with Bruno Bonizzi and a bunch of people, very good people. In Germany, Barbara Fritz and some others. So here, Jean-François Ponceau from Grenoble as well. So we have many people working on that. So what we are trying here is not, is just trying to collaborate with this collective agenda, right? And what is the hypothesis of the article? And then in this sense, we try to bring some new things to the table in regard to those other authors. We try to highlight that these hierarchies, these currency hierarchies, these hierarchies that I was here mentioning, they are not by chance. And also they do not result from any unconformity or any dysfunctionality of the international monetary and financial system. Is not a problem of the system. The fact of, well, there are countries like El Salvador which cannot have a national currency anymore, then they are not problems of the system. Those problems are constitutive of the system. They are functional to the way the capitalist system works and the way the international monetary and financial system works, right? They arise from what we name, and then we try to use the concepts of the Latin American structuralism. They arise from the structural differentiation of the capitalist world. I'll come back to this concept later. And these hierarchies have, as I said, a functionality to the capitalist system. So, as you know, the capitalist system only works with hierarchies. It needs hierarchies in all dimensions. It creates and it recreates hierarchies. Even when you have a continent like Europe, which managed to somehow create less inequality, as it did in some decades after World War II, it recreates inequalities. The capitalist system creates wealth, a lot of wealth. It's a machine of creating wealth and a machine of creating poverty. It recreates poverty, even in places where poverty was abolished. With the euro crisis in Greece, now in the US. So this is the way the capitalist system works, creating and recreating wealth and poverty, creating and recreating hierarchies all over history. So this is an important claim we make, that there is no dysfunctionality. It's the way the capitalist system works. And then we come to the concept of international division of finance, which was firstly mentioned by Humberto Lima, who was a PhD student in Campinas as well. So that's why I'm telling that it is indeed a collective research, because many people are contributing to those discussions. And then we try in the article to discuss the structural differential and structural trends, trying to follow this methodology of the Latin American structuralism. Then starting with the structural differentiation. The idea is that the central and peripheral economies, they have completely different functions when they interact in the capitalist system, right? And then in order to understand it, we have to look into the differences of when we come to the monetary and financial dimension, we have to come to the qualitative differences of the different currencies and financial assets of the world, right? We have to try to understand the different qualities, the qualitative differences of the currencies and financial assets that compose the international and monetary system, not forgetting that we are living in a financialized capitalism, right? And then I come, as I said, to the way we understand financialization, because it's also a term that is used by everybody, but sometimes in different ways, right? Here we try to bring, and we are not alone on that, obviously, important things from the Keynesian discussions, theoretical discussions, right? So financialization is a systemic standard of capital accumulation, right? In which we have the hypervaluation of liquid forms of wealth. And then if we want to put in Keynesian terms, an exacerbation of the so-called liquidity preference. Here in France, you probably heard about Michel Aglietta, and he has a concept. He says that there is this obsession for liquidity. It's not even a preference for liquidity, it's an obsession for liquidity. Right. So in the same sense, there is an exacerbation of the liquidity preference in the current context as something which is systemic. So we are not talking about individual choices of asset managers, investors all around the world. Asset managers and investors, they move collectively, as you know, and this also comes from the Keynesian discussions of the hard behavior and so on, right, conventions. There is a compulsion for the quest, for the search for short-term returns. Again, it's not a choice. Capitalist system is based in competition, and if you are competing, you have to try to, so you have to mimetize, you have to follow what others are doing. So the investors, agents, they are compulsory, mandatorily, they have to go into the search for short-term returns. Right. But it's not only that there is this pressure for the search for short-term returns. There is an institutionality which allows it, which allows the immediate interchangeability of assets for money. Because we can have moments, and we did have in history, when even if people want to change their portfolios every time, several times a day, well, they are simply not allowed. The institutions are not conceived for that. The rules forbid it. There are ways of avoiding it. But now, with the whole pressure that was made also by the multilateral institutions like the IMF, the World Bank, and so on, the institutionality in most of the countries of the world allow this immediate interchangeability of assets for money. Right? Meaning that the portfolios of almost all agents in the world, they are changing very quickly. Every day, every minute, every second. As you know, those changes in the portfolios, the financial portfolios of the agents, do not even depend anymore on an economist like me or any of you, or in a person like me or you. It's all about robots, as you know, algorithms that are trying to capture the very tiny differences in the quotation of a currency in Japan and, I don't know, in Switzerland, and trying to earn money about that. Even if there is a 1 second moment of difference, the different quotes, the robots, the algorithms can capture this difference and earn money about that. So the portfolios are being changed every second, okay? Not automatically, but following the algorithms, right? So there is the systemic compulsion for short-term results. First of all, I should have said it before. The amounts of financial wealth are much higher. We have to depart from this perception, right, than in the past. So we have mountains of financial wealth with the systemic compulsion for short-term returns and an institutionality, and also technology, if you want to put it here as well, these algorithms, which allow these very quick and constant changes in the portfolios of, well, investors all around the world, right? At the end, we have a market dynamism, which is extremely influenced by the state of confidence of the global markets. So if Trump tweets, and he does it, he likes it, then it can trigger, I don't know, you saw even with, he launched his own, it seems like a bad movie, right? The president who is against the central bank digital currencies, and then he creates his crypto asset. But then you saw he created his, and then some tweets, some declarations of Trump or any other important person, politically speaking, in the world or economically speaking, can configure new trends which are followed by many of the important actors in the world. I'll come back to that later. With also this very rapid flow of information circulating worldwide. And then the outcomes, a lot of outcomes, but then we highlight here two interlinked outcomes. First of all, the changes in the international liquidity preference are more frequent and sudden than in the past, because you receive information in the WhatsApp or whatever, or your robot, your algorithm receives the information and does the work for you. So the changes are in the liquidity preference are more frequent and sudden than in the past. And as I said, whenever there is this rise or fall in the international liquidity preference, the agents are allowed, they are more inclined to indeed convert their assets into the most liquid asset of the system, which is money, right? Or abandon money and go into riskier assets, right? So it's a whole new dynamism. And also, and very importantly, it shapes or reshapes what we may name as the nature of the reserve currency, or the essence of the reserve currency, and the essence of the peripheral currencies of the world. So this whole context increases the importance of the system to lean on a particular asset which has the ability to preserve wealth, the store of value of the system. So it's a system which allows, and then I'm quoting Beluso, this Brazilian scholar I named, allows exotic adventurers of financial funds all over the world, so they can invest in an exotic place like Rio de Janeiro, where Alexis lives, or it can invest in any Asian or African country. But it can he or she can quickly come back to the safe harbor, which is dollar, which is the reserve currency of the world, right? The most liquid form of wealth, of financial wealth. Okay, so in the current context, the hegemonic character of the reserve currency, the US dollar, derives very importantly, not only, but very importantly from its role of anchoring wealth in the liquid form. Then, just as a footnote, and we can discuss it later if you want, there are important discussions on what are the determinations behind the internationalization of a currency. So why is it that some currencies are internationalized, some others are not? And why is it that one currency is the key currency or the reserve currency of the world and others are not? And then there's a whole new discussion, but just to, well, obviously, what is behind the reserve currency? A big economy, obviously, but not only. It has to be a big economy, but integrated financially through trade and finance to the rest of the world. But not only. There are geopolitical aspects, right? So it's the size of the economy, but the geopolitical power of the country which is behind this currency. And when I mention geopolitical power, I'm also mentioning military power, right? So we have plenty of examples in the history, in the recent history, when we see that the dollar diplomacy uses the US Army. Okay. It's not by chance that the Bretton Woods conference was held in Bretton Woods and not in London and not in Paris. It was as an outcome of the war and the military supremacy of the US Army, right? Well, the Soviet Union as well, but in the Western world, it was the US, right? And later on, we had also you probably heard about it, in the 70s when the US dollar was being contested as the reserve currency of the world. The US made an agreement with Saudi Arabia in order for the oil barrels to be denominated in US dollars in exchange of what? Military defense. So you see there is a strong relation between currency and currency hegemony and geopolitical power, military power, right? So all those things are very important for us to understand why a currency is the key currency of the world. But still, in the current context, those geopolitical power, this geopolitical power, the size of the economy, are always important. But the fact that the US has the biggest capital market in the world, the most important financial market in the world, makes it the locus for the international investors, where the international investors can anchor their wealth, right, in the most liquid form, which is US dollar. I have to speed up because I see that I already talked for half an hour. And then, just to make it more rigorous, it's not the dollar itself, because obviously the international investors, they are not putting, having cash and putting under the mattress. They have treasuries, right? So they are buying. When I say that, well, they are investing, international investors are going to exotic places and then they come back to the safe haven. The safe haven is not cash, US dollar, but bonds, right? Denominated public bonds in the US, the US treasuries. They are the anchor of the global wealth. So there is this feedback effect between the role of the US dollar, the US treasury bonds as the safe haven of the world, and the US capital market, right? And then it gives perennity to this supremacy. And why is it important to understand? Because if you see, for instance, that China has already, I don't know, maybe Enzo or any other who studies China know it better than me, but 30% of the industrial, the world manufacturing, I don't know. We can say, well, so things are changing, and things are changing, in my opinion, but we have to understand that in this dimension, the US is still incomparable, right? The US capital market is the, by far, the most important capital market in the world, the financial market. The treasury, the US treasuries are the safe haven for the international monetary and financial system, right? It gives perennity to this supremacy. So the nature of, nothing in social science is natural, right? But the essence of the reserve currency in the era of financialization. It is a fiduciary currency. This is a novelty. It's not backed by gold anymore since 71, as you know, when Nixon declared that, well, the US dollar wouldn't have gold as a back anymore. It is flexible, unlike in the aftermath of the Bretton Woods agreement or during the Bretton Woods agreement, the Bretton Woods system. So the exchange rate is flexible. And it is convertible. It can be easily converted by any other currency in the world, liquid markets, right? And then this is important for us to understand the essence, the nature or the essence of the peripheral currencies as a distorted mirror of the reserve currencies. So the peripheral currencies, they are shaped and reshaped according to what happens to the reserve currency of the world, but obviously shaped and reshaped in a different way, in a distorted way, right? Anyway, peripheral currencies are now fiduciary as well. Brazilian real has not gold as a back. It's not backed by gold, right? But, and this is the distortion, but for countries which can do it, their currencies are somehow backed by international reserves. So in Brazil, we have 350 more or less billion dollars as international reserves. And some other, China has 3 trillion, right? And then for countries which have this possibility, not all countries can have it. Argentina, Venezuela are suffering precisely because they don't have international reserves. But for other countries, whenever it's possible, it's recommendable if you are integrated to the rest of the world. Some people name it as the price for the insertion into globalization. The price is you have to have international reserves to counteract when there is this reversion of the cycles, right? So it's fiduciary, but not so much. It's flexible, but not so much as well, because there is this whole discussion of free floating since 2001 Heinrich article. Countries declare, Brazil again, and many other countries in the world, they declare that they have floating regimes for the exchange rate, but they intervene. And why do they intervene? Because they have to. If they do not intervene, the volatility of the exchange rate is so extreme that it creates a lot of problems. So the Brazilian central bank has to intervene, and the central banks of almost all peripheral countries in the world have to intervene. Or they have to impose capital control. And the monetary policy is totally implied in trying to curb the potential volatility of the exchange rate. So the exchange rate is flexible, but not so much. But because the worst thing you can have in a peripheral country is an exchange rate crisis. It creates inflation and so on and so forth, right? And they are convertible juridically. So with the Washington Consensus and everything, so the capital controls were abandoned in many parts of the world. So currencies are convertible, but juridically, but it's not so the international investors, they are not so sure, even if juridically they know they will be allowed to convert peripheral currencies into dollar again whenever they want, they are not so sure that they will manage to do it in a profitable way. Why? Among other things, because precisely of this volatility of the exchange rate. I can explain it in using this figure, which comes from my thesis, which in my opinion makes it easier for us to understand what I'm trying to discuss with you. Here I start with the national dimension, like a closed economy, but then I will obviously open the economy in my following figure. The whole idea is that the investors, the national, in this case, national dimension, the investors, they are allocating their portfolio according to the cycles, right? So whenever we can organize the assets of an economy according to their liquidity, right? So we can have in the bottom, we have the most liquid asset of this specific economy, which is money. It's always money, right? Money is the most liquid asset by definition of any economy. So it's in the bottom, the highest liquidity, right? And then we can organize a whole array of assets according to their liquidity, coming from the highest liquidity to the lowest one, okay? So we can have, I don't know, bank deposits, and then public bonds, and then private bonds, and then the private bond of a very risky company. The idea is that we can organize assets according to their liquidity. from the highest liquidity to the lowest in this vertical dimension, right? And then the investors, whenever there is this moment of euphoria, appetite for the risk, as we name it in the financial discussions, whenever there is this appetite for the risk, the investors, they are prone to invest in the riskier assets. They are prone to allocate a part of their portfolio, at least, in their riskier assets. Why? In order to have higher yields, at least expecting to have higher yields. Because money provides no yield, as you know. It's the 17th chapter of the general theory, right? Money provides no yields. Public bonds provide a yield which is not so high, but then the very risky company of, well, it provides even higher yields in order to attract investors, right? So investors, they abandon liquidity whenever there is this moment for appetite for the risk in a search for yield, right? But whenever the scenario changes, and it changes suddenly with a fake news or a true news, whatever, there is this flight for liquidity, which tends to be sudden. Here it can be gradual, but then it changes suddenly. And the investors search for liquidity. They flight for liquidity. They fly for liquidity, right? They come back to money itself, or more generally to public bonds, for instance, right? So we have those cycles internally. But the thing, what happens with the financial globalization is that the markets are open. The financial accounts are open. So the investors, they have the possibility of investing not only inside their own countries, but in the other countries of the world. And if they can invest in the other countries of the world, they can invest in different currencies as well. So there is a new axe which is open here, if you are discussing liquidity, regarding the different liquidities of the different currencies of the world. Okay? So here it's the same in the international dimension. We still have, we can start with the USA, for instance. We can organize the assets in the USA denominated in the US dollars according to their liquidity. So the most liquid asset is the US dollar cash, and then public bonds and so on and so forth. But we have this new dimension, the horizontal dimensions. Investors can go into different currencies, which can also be organized according to their liquidity. So after the dollar, it's the euro, right, which is the second most liquid. Then, I don't know, the sterling pound, the Japanese yen, the Swiss franc, and then we go into the Brazilian real, the Argentinian pesos would be even further, and then Zimbabwean, I don't know, but you understand. We can have a whole array of currencies organized according with their liquidity as well. And then the international investor, and just to make it clear, it should be a matrix, right? Because above each currency, we can have different assets as well. So we can have euro, and then public bonds in euro, and then private bonds in euro, and the same. So here we have the most liquid asset of the system, US dollar cash. And here we would have the riskiest asset in the system. I don't know. A company which is almost in bankrupt in a very tiny, small country during a war. I don't know. This would be the riskiest assets of the system, right? So the point is that whenever we have the appetite for the risk, moments of appetite for the risk, the investors, they are prone to go in the direction of assets which offer higher yields, in both directions. So they go inside the US, into riskier assets, but they go into other countries. They go in this direction as well. They accept to buy public bonds in real, or even private bonds in real, and so on, right? They go from the bottom to the top, and from the left to the right side. But whenever there is a change, and always there is a change in the cycle, for whatever reason, again, it may be a tweet by Trump or whatever, okay? A phenomenon, natural phenomenon, COVID, or whatever. But whenever the cycle changes, and it's not, again, it's not an individual choice. Investors all over the world, they come back, they do this moment of flight for liquidity. They come back to the most liquid assets of the system in this direction again, but also in this direction, abandoning the assets in the periphery, abandoning peripheral currencies and coming back to the central currencies of the world, very importantly, to the US dollar itself, right? This moment, this behavior is not individual, it's collective, and it's not national, it's international. So it means massive waves, a tsunami of money going to the periphery and abandoning the periphery. It configures the international liquidity cycles, right? Maybe I can skip it, but it's a theoretical discussion. The currency, the peripheral currencies, they can have spasms of liquidity at the international market, but then whenever we have crisis, they lose the liquidity, right? Well, what we see at the end is that we have different qualities of assets, right? This whole story was coming back to the structural differentiation, which characterized the international division of finance, is based in these different qualities of assets, which are the peripheral currencies and the assets denominated in peripheral currencies, and central currencies and assets denominated in central currencies and in the reserve currency of the world. So in the productive technological dimension, you know, the structural differentiation comes from this, so high value added, high technology tasks and, well, low value added, low technology. And in the monetary financial dimension, in the center has assets aimed at maintaining, defending the wealth of stocks. And this is also important for you who likes Minsky. Providing liabilities for carry trade. Okay, so this is the role of this, the center for the international monetary and financial system, providing assets which are safe havens, and providing low-cost liabilities. You can earn a lot of money if you get loans in Japan, paying 1% a year, and then investing in public bonds in Brazil, 13% a year, public bonds. So no risk of default, you know. So they provide liabilities also for carry trade. And the peripheral assets have a totally different, qualitatively different role. They provide assets and currencies that enable the diversification of international investors' portfolio and the valorization of those portfolios, right? And what are the consequences of this structural differentiation? Then we come back also to the discussions of the Latin American structuralism. Dependence, first of all. Peripheral countries are totally dependent on international financial cycles. You can see very clearly the economic growth, unemployment rate, a lot of macroeconomic indicators. They are, at the end of the day, related to the international financial cycles. I don't want to say that, well, national policies are not important, they are. But it's true that the external conditioning is very important in the determination of a boom or a crisis in the periphery, right? Dependency. Then lack of autonomy for economic policy. Then obviously there are divergences even within heterodox economics, because as you know, the modern monetary theory, they would say that there is much more margin for maneuver, but then I'm somehow critic to this claim, because I do think that there is lack of autonomy for economic policy in the periphery. The monetary policy has to try to curb the volatility of the exchange rate. If not, it will create inflation. Okay. Also for fiscal policy, we can discuss it later if you want. And we have a very high external vulnerability, even if it is in new forms. So nowadays, we don't have lack of dollars in Brazil, unlike what happened in the 80s, right? Because in the 80s, and then we come again to the international financial cycles, we had in the 70s a bunch of money going to Latin America, and then the Volcker's strong dollar policy, increasing the interest rate in the US in 79, as you know, and then external debt crisis, right? Last decade in the whole subcontinent. Not only in Latin America, not in other parts of the world as well. So it's not anymore the case. For Argentina and Venezuela, yes, but not for Brazil. We don't have lack of dollars. We have a mattress of $350 billion, as I said. But still, we have a very high vulnerability, in my opinion. which goes into channels which are new. So, for instance, even if there are not a capital flight, we can have important impacts in the exchange rate because of the changes in the international liquidity preference. In the last months of last year, we had a kind of an, we wouldn't name it as an exchange crisis, but we have a big devaluation of the Brazilian currency in Brazil. And it's not necessarily related to capital flights, okay? Because there are new channels. The exchange rate in Brazil, for instance, is very much determined in the future markets, expectations, speculation in the future market, and then it comes to the spot market. We can discuss it later. But I just want to mention that there are new forms of vulnerability, but the vulnerability is still very high. So those are some of the burdens associated to the functionality of the periphery within the International Division of Finance. And then we come to the last part, and I have to do it quickly, of my presentation. We discussed the structural trends. So ICLAC and the Latin American structuralists, they claimed that there was a structural trend related to International Division of Labor, related to unequal exchange, so the unequal exchange between industrial goods versus agricultural goods, and dynamically a deterioration in the terms of trade. So we probably studied it. So the prices, the relative prices, right, of agricultural goods declining in relation to manufactured goods, right? So this is the whole discussion of ICLAC. And then what we claim in the paper is that we have also a structural trend arising from the International Division of Finance. Because peripheral economies are articulated with central economies in a way which determines the process of net transfer of wealth from the periphery to the center. And then thanks to our referee in the journal, because we didn't, in the initial version of the paper, we didn't have the empirical part, but then he or she pushed us to make the empirical part, and indeed, I think it was a good addition to the paper, because we tried to show it empirically with a very simple exercise, but interesting in my opinion, coming from Akius. This is a paper from Akius, in which he tries to calculate the total rate of returns of external assets and liabilities in some countries, in some specific countries. In his paper, he uses 12, 15, I don't know, countries in the world, trying to show that, well, the liabilities in the periphery have higher costs than in the center, right? And this is the way he does it. He takes into consideration the yields, if they are public bonds, for instance, the interest rates, but also capital gains and losses. Why? Because the external, all assets, right? But in this case, external assets, the stock of wealth can decrease or increase according to variations in the price. You can imagine, for instance, equities, right? The equities can increase or decrease. And the exchange rate, because if the equities are in Brazilian or public bonds in Brazilian real, and there are 20% devaluation, it's a big loss for an international investor. Or the contrary, if the Brazilian currency appreciates, it's a big gain for the international investor, right? So we have to take into consideration yields, but also these movements of the stocks, capital gains and losses. I won't go into the details, also because of the time, but it is in the paper. You probably saw it. And what we did in regard to Akius is that we updated it, because he did it until 2016, I guess. But very importantly, and I guess this is a good contribution, we have data for the whole world, because he did it only for 12 countries, and we did it for almost 200 countries. And using, then obviously we cannot go into the details of each country. This is also, when I said there is a whole avenue for research, we can explore those data for each country or each region or each sub-region, I don't know. But we did it with this dichotomy, center-periphery, and those are the results. Very quickly, this is yields, right? For the assets, it was a surprise for me, but it's understandable that the assets detained by central countries and detained by peripheral countries have similar yields. It's here. You can see they go, they have similar paths, right? Meaning that very probably the portfolios in the periphery are more or less as diversified as in the center. So the yields are more or less the same. But the liabilities are completely different. This is what we expected, and this is what we found. You can see that the liabilities in the center, they are around, it comes from the beginning of this century, 4%, 5%, and then 4 again, and now 3.5. And then in the peripheral countries, you can see that the liability is always higher. The cost of the liability, the yields of the liability is always higher. 6, it reached 8, then it came back to 6. And obviously then, if we go into the differential, for the periphery, this differential between yields earned with assets, external assets, and paid for external liabilities is negative. And in the center, it's positive. That was only for yields, and here we have yields and capital gains and losses. Again, you can go into the paper for the details, but when we have the total return, you see, and then we split it like accrues in different sub-periods, but 2000, 2003, we have the differential of what residents in Brazil earn for the assets and they pay for their liabilities is very much negative, is minus 5%, right? Whereas for peripheral countries is not so high, but still it's positive, right? And then we can decompose it in the yield and capital gains and losses. But the whole idea is that as we expected, peripheral countries are paying much more for their liabilities than they earn for the assets, whereas for central countries, it's the opposite. So we have a transfer of wealth from the periphery to the center, and then I'm almost done. What we see is that there is this structural trend at the International Division of Labor that was studied by the classical authors of ICLAC, which has to be updated, but is still, we see that the higher value added tasks are in the center and low value added tasks are in the periphery. So we still have this structural trend of transfer of wealth. But we have this other one, this other dimension of a structural trend at the International Division of Finance, which finally configures what we name in the paper as a double capture of wealth. So there is a double capture of wealth, double transfer of wealth from the periphery to the center, both through the productive and the financial spheres, which are intertwined, obviously, right? This is not new, obviously, right? This is not new, but it comes to a paroxysm with financialization, with deregulation of the financial system, with the integration of all economies in the world, right? So it's not new, but it comes to a paroxysm now. Final remarks. The peripheral condition is a relationship that denotes dependence and functionality of the economic peripheries concerning the center, which is not static. So I don't want to say here that, well, everything's the same. Obviously, no. It renews itself all over history, but the essence is kept. Right? It has new determinations, new mediations, but this dependency and functionality are kept. Right? And it's also important to say that, well, this International Division of Finance, it restates the peripheral condition in a way that, well, it's not that it operates by itself alone, in isolation of the productive dimension of peripherality. They are both sides of a same coin, right? But it has an own logic, and it deepens the peripheral condition. So this is the important thing. Both dimensions of peripherality, the productive technological one and the monetary financial one, they converge in deepening. They have feedback effects, and they converge in deepening the peripheral condition of these countries in the world economy. And then the paper by Anina was very interesting because she studied precisely some companies in showing that, well, these, in concrete terms, this very strong relationship between the peripheral condition in productive technology and monetary financial dimensions. For analytical purposes, we can make this division, but always having in mind that we have to understand this peripheral condition, peripherality, as a whole, right, in its entireness, because they are two dimensions of a singular division of the world into a center and a periphery, right, which is renewed over history, but it demonstrates the functionality of the periphery for the center, okay? To potentialize the process of accumulation of wealth in the center. And I finish here. Thank you very much.